Chapter 20, Active Trader Status. If you trade 9 to noon, then you can qualify for special tax treatment in futures, equities, and other asset markets that allow you to deduct many of your trading expenses that would otherwise go taxed. The following specialty tax treatment does not apply to you if the IRS classifies you as an investor. You're an investor if you buy and sell securities, expect dividend income or interest, expect capital appreciation, hold securities for personal investment, not for business, and hold most investments for a substantial period of time. As an investor, you pay for your access to investment asset growth through the American stock market when you sell securities. You report your capital gains and losses on Form 1040 Supplement Schedule D. If your broker provided 1099-B is incomplete, then you must also file Form 8949 to report your securities sales. Subtract your taxable yearly capital losses from your yearly taxable capital gains to find how much tax you owe at the end of an investing year. As an investor, you can deduct up to $3,000 of losses that exceed gains from your income, $1,500 if married filing separately, 2018. If you still have excess losses after considering the wash sale rule discussed earlier, then you can carry your loss deduction indefinitely into future tax years. Brokerage commissions are included in your capital gains and losses as part of your position's price basis, and investment income is not subject to self-employment tax. It is very difficult to qualify as a trader unless you trade 9 to noon. If you classify as an investor but still want to wiggle out some capital gains taxes, do not worry. You will get to entity formation in just a moment. With that said, let's move on to active trader status. You can qualify for this special treatment if you buy and sell securities for your own account and seek to profit from daily market volatility, not dividends, interest, or capital appreciation, have substantial trading activity, and carry on the activity with continuity and regularity. If you cannot clearly decide if you qualify for this status, also consider typical holding periods for securities. Shorter is better, but always give your trades time to work. The frequency of your trades. Higher is better for diversification and maximum opportunities, but try to start with quality setups. The dollar amount of your trades. Higher is better, but always stay within your risk tolerance. The extent to which you pursue the activity to produce income for a livelihood, and the amount of time you devote to the activity. If you meet these qualifications, congratulations! You can now record your active gains and losses as a business. This preferred tax status stands independent of the markets you trade. So you can be an active trader in the stock market, but only an investor in the futures market. Keep detailed records with your broker, separating your investor positions from your trader positions to minimize your taxes. You can easily isolate your 9 to noon trading with a separate brokerage account from your long-term investments. As an active trader, you get your report and deduct your necessary and ordinary business expenses alongside your trading income on Form 1040 Supplement Schedule C, profit or loss from business. Sole proprietorship. On top of that, you still do not have to pay self-employment taxes on your income. As an active trader, you can use your Schedule C to deduct the cost of trading software, investment advice, interest paid, for example, margin interest, which you will faithfully avoid, bank fees, equipment, for example, computers, monitors, desks, bookshelves, etc. that you can use more than 50% of the time for trading, research tools, educational content, for example, books, seminars, etc., internet access, market data fees, startup costs like this book, home office costs. Maximum 2018 home office deduction is $1,500 per year, with the largest deductible 300 square foot home office, and any other trading related business expense including transportation costs, standard driving cost deductions, business meals, lodging, etc. As a standard investor, you cannot deduct any of these expenses from your trading income outside of electing to itemize deductions. As we talked about earlier, you can deduct certain investment expenses on the Schedule A that exceed 2% of your adjusted gross income. Phasing out in 2018, see Chapter 8. With active trader status, you can directly deduct expenses and losses from your trading business Schedule C income. Because all of your active trader losses become ordinary losses from your business, you also need not worry about maximum yearly deductible losses. With that said, commissions are still considered part of your cost basis, but profits and losses are exempt from self-employment tax, Social Security, and Medicare taxes. Alongside the benefit of deducting business expenses with active trader status, you can file a Section 475F election, the mark-to-market election. This election applies to your mark-to-market status to both your personal investments and business active trading income. On the mark-to-market election under Section 475F, you consider all of your positions closed on paper at the end of the year, and all of your capital gains and losses turn into ordinary income. You then pay taxes on all of your realized and unrealized gains that year in your return. Mark-to-market accounting prevents you from deferring taxes and prolonging tax-free asset growth. With the Section 475 election, you will have to pay out of your pocket for long-term unrealized gains. After you pay taxes on your open active trader positions based on the last business day closing price of held positions, the new tax basis for the underlying investments is the year-end fair market value. You can only make the mark-to-market election once, and it is almost impossible to unelect. You might make a mark-to-market election as an active trader status individual if you want to bypass the wash sale rule, which disallows long-term or short-term capital gain liability deductions from losses when you sell for a loss and buy the same stock or a substantially identical security back within 30 days of the sale, or deduct an unlimited amount of losses per year. If you deduct a significant business loss, you can even carry your net operating loss back 2 years and forward 20. This loss can also lower any other taxable income since the Schedule C is part of your individual return. With that said, you'll almost exclusively attain active trader status only when you trade 9 to noon. Mark-to-market accounting might make more sense for you if you consistently trade the same stocks over and over. However, 9 to noon stocks constantly change, and you rarely need to worry about the wash sale rule because you're always trading different pre-market gainers, which we will explore how to find these stocks in Chapter 36. Additionally, you trade actively to make money. If you consistently lose at the end of the year while actively pursuing your education, trading practice, and self-discipline, then you might not want to actively trade. Using the technical analysis techniques we explore in Part 2, you'll learn how to consistently be profitable when actively trading, so you do not need to worry about deducting over $3,000 per year in losses. If you fear a large market crash one year, weigh the cost of permanently paying taxes on unrealized active gains against the benefit of deducting an entire yearly loss rather than only $3,000, 2018 limit. We will look at using business entities soon to get around active trader qualification stipulations. As an investor, you report gains and losses on your Schedule D and Form 8949. As a trader, you report gains and losses on Form 4797 if and only if you make a mark-to-market election, securing your sales as ordinary gains and losses, not investment sales. A mark-to-market election protects your clearly separated long-term investments from active tax status. Individually, you have to claim mark-to-market accounting by the due date of your personal tax return, tax day, 1 year before the change takes effect by attaching a statement either to your income tax return or request for an extension of your time to file your return. This prevents individuals from claiming mark-to-market status immediately after a large loss. However, you can elect mark-to-market accounting immediately when you start a business. If you elect mark-to-market accounting, your business trading becomes ordinary income taxed on your return after deductions as income. However, this makes little difference thanks to the similarities between short-term capital gains taxes and income taxes as shown below. And then it shows the short-term capital gains tax rate 2008. Depends on your situation from single, married, filing jointly, head of household, married, filing separately. And then the rates range from 10 to 37% depending on income. And if you look at the income tax rates, the same qualifications and the same percentage changes. It's literally the same tax rates with the same income determinations for those tax rates. So notice that they are the exact same. So you end up paying the same tax rate, but you can deduct all ordinary and necessary business expenses. If you elect to use mark-to-market accounting as an individual or business, you must also file Form 3115 with your timely notice. Your timely notice must state that you are making an election under Section 475F, the first tax year for which the election is effective, and the trade or business for which you are making the election. Make sure you explicitly separate investments from trades. You will essentially only get approved if you consistently trade 9 to noon. However, do not file Form 3115 at the same time you make a mark-to-market election. Rather, file Form 3115 to change your method of accounting for securities when you file your first year's tax return using mark-to-market accounting as specified in your previous notice. Like we said earlier, you can try to stop using mark-to-market accounting for securities by filing an automatic request for revocation under Revenue Procedure 2017-30, Section 23.02 by the original due date of your return, but these requests are usually denied. One last special tax trick you can pull as an active trader is claiming a Section 179 deduction and writing off up to $1 million a year for equipment used in trading activities, rather than amortizing or depreciating the equipment along a curve like the modified accelerated cost recovery system, though you cannot force your trading business into a loss. 2018. Active trader status creates an individual sole proprietorship under which you trade, though you do not pay self-employment taxes. If your trading gets especially serious, you might want to protect your assets and further reduce your tax bill by creating an actual trading business entity that you work at. This way, the assets you manage are not actually yours if someone sues you. By creating a limited liability company or corporation, you can avoid the hassle of qualifying as an active trader. You can always deduct business expenses as a separate entity. Additionally, you can dissolve your entity at any time, perhaps to stop using mark-to-market accounting for your trades. If you want to use mark-to-market, you can start using the accounting when you form your business rather than waiting a year, since it is just another form of business accounting. LLCs have flexible tax structures, so you can treat the entity as a sole proprietorship, partnership, S corporation, or C corporation. Corporations simply stand as the latter two options. LLCs formed under the former three classifications qualify for the 20% qualified business income deduction if you meet the income limitations under Provision 11011 Section 199A of the Tax Cuts and Jobs Act. This directly lowers the amount of taxable income you report since you operate a specified trade or business in investment management and trading. However, at S corporation or C corporation, you'll have to pay yourself reasonable pay for the business, which is subject to payroll taxes. However, you can take a K-1 distribution of profits from an S corporation that counts as income exclusively, bypassing Social Security and Medicare taxes. With a C corporation, you can take dividends from your company. Remember that you can also hire your family as employees of your corporation. With this strategy, you can use your increased flexibility in accounting to fund your children's colleges, while with tax-free profits, cover deductible medical expenses, and distribute money to your family with pre-tax dollars through many other accounting tricks like ERISA pension funds and newfound 401A plans. One final tax strategy involves combining LLCs and corporations. While maintaining limited liability and separate assets, you can charge a C corporation royalty to the underlying LLC as a business expense. The combination structure is used in very limited circumstances to utilize the advantages of each type of business. Consider opening a business entity for your significant active trading. Consider whether a 20% qualified business income deduction makes more sense than the added accounting and business expense flexibility of a corporation or LLC tax as a corporation. S corporation distributions in particular help you take cash out of your trading after deducting any business expenses you can conjure up.